All right. Anyway, we were talking about auto documentation at the end last time. So and like you said, you can read these chapters. Well, I could if you guys are really bored with doing it. Just so I could give you some journal articles about auditing to read. From audit researchers. Never mind. Okay. So I'm not going to do that. I want you to learn this stuff. Yeah. So the effective technology, maybe that they talk about this a little bit in this chapter, and then throughout the book they talk about it. But this is really big, isn't it? More and more. Did you guys do any auditing with pencil and paper, or did you do auditing online? Out there working. Both.
That's how financial statements and
did you?
After I had it on the computer.
Oh, after you done it, why did they do that? When you were proofing it after it was printed out. Yeah, they just wanted to be real careful.
Like I made all the tick marks like on the computer. Yeah, that one was stored in the file. And I don't know, I didn't know.
They had you do it by hand too, just to make sure, double check, basically. Okay, that's fine. Yeah. So what did you do on pencil and paper? Same idea. Did you do any worksheets, pencil and paper, or were they online? Almost always online. And a little tiny CPA would do it pencil and paper, and it's the same stuff. It doesn't make any difference. It's kind of hard to see it when it's online sometimes, isn't it? It's electronic. It's kind of hard to see what's going on, so you have to really think about where things are connected. But also, the accounting systems are all online, of course, right? Nowadays, everybody is doing everything electronically. So what happens as a result of that? Internal controls are more and more important, not important, but they're really even more important, and the electronic controls are important. So obviously, auditors must evaluate how electronic information affects their ability to gather evidence. Can you find it? Right? And is it valid? Is it real? Electronic signatures are a real problem. But you know what? Before we had electronic signatures on checks, things like that, documents, we had little plates. Have you ever seen that? Where they just stamp the signature on the check. And you have to control the signature plate, right? Because otherwise anybody could write a check and put the president's signature on it because you have a signature plate, right? That's how they did it. Well, now it's online, isn't it? Is it important to control that signature? Yeah, right? Control your blank checks, right? Although nowadays they're not even necessarily blank checks and blank invoices and so on. They're blank sheets of paper that you print everything on. Or even more so, it's just an electronic transfer of funds, isn't it? It has to be approved, you still have to have a signature, and you have to make sure that all of them are properly approved, so it gets tougher and tougher. So just things to think about, right? And then we're going to use the computers to read and examine the evidence. Well, I think that's fine. You can find things online easier than you can in print, right? Pull things out of a file cabinet, it's easier to find it online. Can you be sure you're getting original documents? Because of how well they are safeguarding all of their records, huh? Who has access to the records, and you can change those records. So you look at all that stuff. That's just internal control, isn't it? And so I think it's far better to be able to pull it up with the computer and read it online. That's fantastic, right? But is there evidence then that they've properly authorized the disbursement or properly authorized the purchase or properly authorized the sale or whatever it is, properly authorized hiring somebody? Well, again, it depends on their controls, right? And it depends on how they do their documentation throughout their system, too. Okay, so you do an awful lot of that. So it's the same thing, just electronic. This one's really great. Most of the software programs nowadays are Windows-based. Have any of you ever worked in systems that were not Windows-based? DOS-based? Oh my God, it's just unbelievable. You get a screen with a flashing cursor on it. Well, you've seen that, right? When Windows fails, right? Comes up, right? And it doesn't know where it's at. The computer's usually lost nowadays if it's not in Windows. Well, it's not really lost. You are. It used to be everything was that way. There was no such thing as Windows. Apple created Windows, not IBM PCs. And they, Apple tried to trademark it. They're not successful. So, because they were going to be the only ones that had a Windows operating system, basically. They didn't call it Windows, they called it Apple, of course. Right? So Windows basically, IBM sold it. Right? Really early on. Court cases about it, all kinds of stuff. So, but anyway, yeah, usually Windows you actually operate the thing, you see what's going on. But you need to know what's going on behind the scenes too, right? The code. So what we'll have is we'll have people in the big firms and in smaller firms, not regional so much, but national firms, and maybe to some extent regional. You've got people who can audit their software, right? And determine whether or not they're good at doing controls of the software. And so if you've got that capacity, if you do, anybody doing the systems and accounting? Not very many in Bellarmine do because of the way our systems programs are. They're not connected with practice. Let's put it that way. So, but anyway, it's a really nice way to go. So if you want to add that later in your career, if you want to do some systems stuff as a master's, you could be very, very valuable as a result of that. And we've had some students do that here too. Okay, build that. The other thing you can do with the system side of things is you can learn while you're working. They'll send you to seminars, they'll send you for training, because everybody's looking for people who are interested in working on systems audit. Okay, so, and it's not, systems audit is not separate from regular audit. That makes sense? Because we use systems for everything. Okay? The other thing that we do, of course, with the technology, which is just wonderful, if you let the technology use it to pull up your samples and manage your samples, determine what your scopes are going to be for sample sizes, either computations, right? And then pull the data, manipulate the data, test the data. You know, we can use software programs, computer assisted audit techniques all the time, and more and more and more we're doing that. It saves an awful lot of time. Okay, so really nice tools. So they didn't say too much about it in the book, but that's because old auditors are writing instead of you guys. Right? So think about what you know. Is that a mischaracterization? Doing everything with computer, huh? It's just seamlessly. Okay, although you know, I think about my grandkids. They're going to run circles around you guys. They might. It's kind of scary. Yeah, I mean, knowing how to use a computer, cell phone, computer. You know, my grandson in his ridiculous video games, he's got probably 1,000. He's 7. They're free. Some aren't free. Right? Some are free. And you can do them all. That's what it works. What's up? Can you guys? We just turn into, video, what do they call those people? Only play video games, do nothing else. I don't know. Yeah, I sort of. Yeah, but anyway, yeah, he's pretty social. So, but then all of his friends too. You know, you just use computers all the time for everything. It's just no big deal. And so, anyway. So, worth mentioning. Worth mentioning. So I went back to that. Okay, so let's take this chapter. What's going on here? More of the same. Lots of repetition here, like we say, but, it's what it is. Audit planning and analytical procedures, so we're going right down through. Okay, so what's the deal in your planning? Those generally accepted auditing standards, one of them is what? Right there in front of you. The order is planning work properly supervised teams. And but this first piece is that's true. But what's this first piece? Obtain sufficient appropriate evidence for the circumstances, right? Appropriate evidence, sufficient competent evidential matter to support your audit opinion, right? And part of that is, of course, planning what you're going to do, and part of that is training and supervising your assistants, right? Okay, so sure. All right, so yeah, sure. The main reasons for planning, you get enough evidence, right? And the right kind of evidence to help keep audit costs reasonable so you don't waste time. And to avoid misunderstandings with the client. And in this chapter, they talk about engagement letters. We always do engagement letters no matter what we're doing. If you're a firm that does audits, you do an engagement letter for virtually anything you do. You're doing management consulting, you give them an engagement letter that says, we're doing management consulting and what all the tasks are, but we are not doing an audit. If you're doing a compilation, you say, I'm doing a compilation, I'm not doing a review, I'm not doing an audit. Doing a tax return, you say, I'm not doing a review, compilation, review, or audit. Get the idea? Tell them exactly what we're doing and what we're not thing is we're going to tell people we're not doing an audit if we're not doing an audit. We don't want there to be any confusion. I looked at your records, right? And I might even do some things that might look like an auditing procedure because investigating something. No, I'm not. The engagement letter we both signed says I am not doing an audit. You might still get debate about that, by the way. What happens if you do enough work that you could issue an audit opinion? You collect enough evidence that you should be able to issue an audit opinion. What must you do? Issue the audit opinion, no matter what your engagement letter says. Right, guys? So always careful not to do too much work. Also, you can be telling the client the things you didn't need to do, right? Same with a review. When you do a review, you don't do an audit. You stop. Okay? You don't do as much work. And on a compilation, you do pretty much nothing. Okay? Read the financial statements and gain an understanding of the client's business, right? What they do, and that's it. Yeah. Okay? Now, if you see something that looks obviously wrong in the financial statements, will you help them fix that? Yes. Does that turn into a review or an audit? No. Okay? So, all right, but you're taking no responsibility, so basically don't do anything. Okay? By the way, if you were a CPA, if you have a CPA working for your company, does it make sense to get a compilation done? Yeah, probably. Compilation really is helping you put together your financial statements. You have a CPA working at the company because they do their own. What do you gain? Now, a lot of people do this, but what are you gaining with the compilation? I don't know. You gain independence. They're independent. But all they're taking responsibility for is reading the financial statements, helping you put it together and read it. So how important is independence? Well, it is important. If you're not independent with a compilation, which you just telling me we're not independent. So if you're working for a company and you want to do a financial statement form and you're a CPA, you can give them a compiled financial statement if you want to. Just say you're not independent. Or if you want to do it for your brother or your sister or any relative, right? You're not independent, so you can do that too. So there's ways we can do this, but I don't think that it's really appropriate if they've got their own staff that could do it to have a compilation. I don't think it makes sense. Personal preference. Okay, so where are we at in this? So when you're planning the audit, designing the audit approach, what do we have? Accept the client and perform initial audit planning. Here's the thing to keep in mind. We are not McDonald's. If somebody comes through the drive-thru at McDonald's and they have real money, we will give them whatever that stuff is we sell, the food, right? We will hand it out that window and give it to them, right? We don't check out whether they have a high level of integrity. We don't check out whether or not they're a felon. We don't check anything except are they giving me money for the food. Right, guys? Most businesses operate this way. We will sell to whoever, right? We just will. Okay? We don't do that. We check out anybody we are going to do business with because they could take us down. If they lack integrity, if we get wrapped up with them, if they lie in their financial statements and we give them a clean opinion, right? And they pull the wool over our eyes, we're on the hook, right? If investors, if lenders, anybody relied on the financial statements that we audited and gave a clean opinion on, we're getting sued, right? We're responsible. Okay? Plus, we're responsible for protecting the general public from folks that lack integrity, right? That's part of what we do. We don't guarantee anything, but that's part of what we do. So accepting the client's a big deal, right? We actually decide whether or not we want the client. So if you're doing bids on engagements, you check them out before you do a bid, because if they accept the bid, now you're their auditor, right? Okay, so you're developing a relationship with them. And we perform initial audit planning. Okay, we'll talk about that. Understand the client's business and industry. If I'm doing an audit, a review, or a compilation, do you think I had to understand the business and industry before I do that? Yes. Can you take on clients where you don't understand the business and industry? The answer is no, but can you obtain the understanding so that you can have that client? Yeah, you can always educate yourself, right? And you go out and hire people who do have that expertise, right? You can have your auditor staff, okay? Sure, yeah, of course you can. Bring in a partner, whatever. Okay, we're going to assess the client business risk. Business risk is what, Jake? Risk of what? The risk is the business will do what? Failure. Yeah, that's it. Business risk is the risk you'll lose your money. When you invest in the business, you will lose your money because the business goes bankrupt. They lose their money, right? That's all business risk is, okay? Are we eliminating business risk in an audit? No. If we were, we would take all the returns, right? That'd be my fee. If I'm taking all the risk, I want all the money. Right, guys? So what are we doing? We are helping the client manage business risk, right? stockholders, present stockholders, potential lenders, present lenders, right? Sure, okay? So we are helping them manage business risk. So what risk do we reduce? Not business risk. We're not going to have an impact on business risk. We don't run the business. What are we going to reduce? Information risk. Because the client's giving them information, we audit that information, right? We give an opinion, right, about that information. And that opinion helps effectively reduces information risk because it's information. I would not invest in a company that's not an audit. Absolutely. Right? There's no way. Okay? They can't even get an audit done? Really? They can have to be very big to get an audit. Okay? So it's to protect shareholders. Lenders, both. Okay? All right. Okay, so then we perform preliminary analytic procedures. You guys did this pretty good last time. Some of you did. When do we have to use analytic procedures? 2 times we must use. We are required to use. Yeah, the beginning and the planning phase. Need to know that. Okay? All right. And then when is the other time we do it? At the end of the wrap-up phase. Okay? Why would you use analytical procedures? At the beginning is to highlight areas where you might have problems, things you need to really look at, things that look unusual. Okay? At the end, it's exactly the same thing. You made a whole bunch of journal, the client has made a whole bunch of journal entries that you recommended to them, right? In between. So maybe the ratios look different than they did at the beginning, or maybe you just haven't checked some things out yet, but you still need to, that sort of thing. So analytical procedures are really useful at the preliminary phase, right? Preliminary planning phase, and at the end. Okay? When is the other time you can use analytical procedures? During your testing. And what would it probably be? Testing controls? No. How would you test whether or not somebody did something by doing analytical procedures? What are you really testing now? Balances. So it's what? It's a type of a substantive test, substantiating in the balances with the analytic procedure. You're looking at whether a number is reasonable, right? It's a number, right? It's not whether or not they follow their controls, which would be testing controls. They meet that, okay? Everybody got it? Always have. Well, ever since we started using controls, I guess. All right. Which was before my time. Okay, we started doing that. All right, so then what we're going to do is we're going to set materiality and assess acceptable audit risk and inherent risk. Okay, what is materiality? A material amount is something that would affect a reasonable user's decision about whether to invest in a company, loan to the company, do transact business with the company. Remember, this could be vendors and customers too, right? Could be the government, right? Could be employees. You name it, really, if you think about unions. Okay, so setting that materiality scope is a reasonably informed financial statement user, right? Would it make a difference in their decisions? So that's the overall scope of materiality, but then we're going to set scopes of materiality in each area of the audit. What will you do for that? You get the overall scope of materiality. By the way, might that be different on the income statement, net income, than it is on the balance sheet, total assets? I bet net income is a different number than total assets in most companies, huh? Right? Different size in most companies. Okay, so it might be different for revenues, might be different for expenses, might be different for net income, might be different for assets, liabilities, equity. Envision this. Then what you could do is you could take your scopes that you set for materiality, we call it a scope, okay? The amount that we think is material, so the scope of materiality in total, and you could spread it across a whole bunch of different accounts. Maybe all the accounts in the balance sheet, okay? So that the sum of all these, right, if you added up errors in all of them, or misstatements in general in all of them, it won't be above your scope of materiality in total. Does that make sense? Okay. What a lot of firms do is they'll assign more materiality to each of the individual assets or liabilities or revenues or expenses or whatever you're working on. They'll put more on each one than a proportionate share. So when you added up all the scopes across the entire audit, it's more than what you could live with. And what is your assumption there? Sometimes you're going to be overstated, sometimes you're going to be understated, and those will balance out. The risk is what? They'll go the same way, and now you're over your scope of materiality. You've got to go back and do more work, or you can't give an unqualified opinion. Okay? Make sense? But will it save you a lot of work? You have higher materiality scope. Yeah. What we're saying is how big an error has to be material. So what happens to your sample sizes if it's real close? If the scope of materiality on accounts receivable is real close And then the things that I think might be problematic, maybe receivables in some companies, depending on how good their internal controls are, right? How far off I think they might be, okay? And inventory. Inventory is a big account for lots of companies, right? If they're a merchandising company, manufacturing merchandising company. Big account. And we've set a scope of materiality pretty high because they're subject to estimates, lots of errors maybe, lots of transactions going on, hard to maintain the internal controls. But again, how good are your controls, right? By the way, the controls are really good throughout the volume. Then the scope of materiality would be pretty low. And without blowing the audit out of the water, right? What do I mean by blowing the audit out of the water? If you're above the scope of materiality, you have to go back and do more work. You're confirming accounts receivable, you're sending out confirmations. You want to go send out more after you did them? Oh God, it's way too late. It's expensive. It's going to delay the audit. And it's just a nightmare. You want to send out the amount, all of them you're going to send out right at the beginning of the audit, right? So it's this planning, okay? So what do you expect to see? So when we say we're assessing the client's business risk, and then we're performing preliminary analytic procedures to see whether or not that assessment makes sense, right? We believe it, right? And then we set the materiality level based on that, okay? That's all that's going on. And we assess acceptable audit risk. Now, this is a firm decision. What do the partners want to do? And usually we'll say it's 5 or 10%. We usually use one of those. Because if we use less than 5%, we probably can't do the audit. It'll be too expensive. Risk of what? What's audit risk? The risk of audit failure. What's audit failure? So let's issue a unqualified opinion when it should have been qualified, or the reverse is true too, of course, right? Issue a qualified one when it should have been unqualified. Make sense? Okay, guys? So, yeah. So here we go. Firms are willing to live with a 5 to 10% chance of blowing the audit? The answer is yes. That's the auditor's business risk, huh? I did everything I meant to do, and I had the wrong opinion. Usually we worry about giving unqualified when it should be qualified. Middle is not as dangerous. Why? Because the client will tell us, no, you screwed something up. You got to fix this. If they are fraudulent, or even they've made a lot of mistakes, or they don't even know, and they'd like to get rid of you, if you're giving them an unqualified opinion, what are they going to say? Thank you. Here's your check. Goodbye. What if you're giving them a qualified one if they think that's inappropriate? They're going to be all over it, right? No. Your sample sizes aren't big enough. You made mistakes in your auditing. Something's wrong, right? Your sample was selected improperly. Something's wrong, right? Either that or they'll actually change the statement, although then you could have to change the statement to make correct it being incorrect if you were wrong. That's also audit failure, of course, right? Okay, so anyway, things that could happen. All right. So acceptable audit risk, and then what's inherent risk? Before you even test it, right? So some industries are inherently more risky than others. I always like to think of wildcat oil drillers. There are people who go out and drill holes in the ground, hoping to get oil. And if they do, they make little mining operations. If they do, they make a lot of money. And if they don't, they make nothing. And then they go drill another hole. They go drill another hole. So what happens to most of these companies? They go bankrupt. Extremely high inherent risk companies. Now, is Exxon a high inherent risk company? They drill a lot of holes. No. Each hole is immaterial to them, right? It doesn't matter. But what if you had everything on the line every time you do something? Drug companies, the same thing. A brand new drug company, are they risky? If the FDA does not approve it first, if the drug doesn't end up working for whatever they're trying to develop a drug for, it's over. And they spent a lot of money getting to that point, trying to do research and development. And then, if the FDA doesn't approve it, it's still over, right? They're done. Okay? Think about Lilly. Eli Lilly, right? Very big drug. Yeah. Pfizer. Think about Pfizer. Another big drug company. Are they living in that world? No, they have all kinds of products. If one fails, oh well. Right? I mean, they don't like that. But if one fails, they can get it on. Right? You have several more coming online. And they have big producers of revenues all the time, right? Okay, so they live in a different world. So a brand new startup company in the industry is what? Inherently more risky than a well-established one. It's just true. But some industries are more risky than others. The toy industry. Unbelievable inherent risk. Why? Because if you happen to have a popular toy at Christmas, you make lots of money. And if you don't, you lose lots of Mattel. Balance, their income just bounces around year to year to year, depending on how hot their new product is, right? Sony, everybody thought Sony PlayStation, you know? Have you ever seen those? Does anybody have a Sony PlayStation anymore? They still have Xbox, right? Is Sony doing what they used to do? No, because they have too many competitors, right? I guess there's other ones that are better or just as good or something, right? Like the Xbox.
Yeah, that's Microsoft.
Microsoft has a better one.
Microsoft makes Xbox, Sony, PlayStation.
Oh, okay,
So
so
they're like-
Xbox versus PlayStation, and
So they're like
Microsoft
a
has been kicking this out of
Yeah.
yesterday. I don't remember. Okay, yeah, so, you know, so what, can your fortunes change? Yeah, so it just depends on the industry. Okay, so, and it also depends though on what's happening in the world, right? Are companies in Afghanistan and Iraq inherently more risky than companies in Canada and the U.S.? Yeah, right? The world that you're living in, right? Okay, so it can be outside factors, it can be your competitors, so we're going to look at all kinds of things for this, okay? So you're doing the inherent risk and the audit risk, and then the inherent risk, and then what else is there? Oh, control risk, and what's that? I can mitigate the inherent risk by doing what? Having really good internal controls, right? I can make things better, I can reduce my inherent risk, okay? And then there's one other thing I can do, right? Oh, by the way, to do the internal controls, I developed an understanding of the internal controls, right? And what am I going to do with that one? I'm going to assess the control risk. This is a preliminary assessment of how good the controls are or aren't. What if I think the controls are horrible? Publicly held company, I can't do the audit. I can't give an opinion on the internal controls. How about a privately held company? I can do a whole bunch more substantive work. Or if they're weak in general, even in a public company, I can still do the audit. They have them, but they're kind of weak. Then what would I do? In both cases, I can do a lot more what? Just think about this. Their controls aren't very good on how they record their transactions, how they summarize everything. So I don't trust the balance sheet and the income statement and the cash flow statement. Huh? Their controls, they probably didn't get there. Everything's probably not right. What will I do if their controls are weak? I'll do an awful lot more testing, but not more testing of the controls. I'll do more testing because I think they're weak. What will I test? The balances and the transactions, right? The transactions getting the balance there in the first place, right? Recording the transactions. Test the transactions and details of transactions. And test of the ending balances. Substantive testing on the ending balances. Make sense? So I'll tone down my test of controls, do less, and I'll do more substantive. Okay? So for a private company, we just do the audit by just beating it to death, right? It might make a really expensive audit though, okay? Collecting more and more evidence. You could do a balance sheet audit and not do an income statement audit, perhaps, because you're more heavily dependent on controls for an income statement audit than you are for a balance sheet audit. Make sense? Right? The balance sheet, I can tie those numbers down pretty well. Try and tie down sales for a company. Try to tie down cost of goods sold. There's a lot goes into it. Tie down cash, accounts receivable, inventory. You can audit that, right? Land, buildings, equipment, and all the debt, and so on. Okay, so anyway, sort of get the idea of that. So we're going to get the understanding, and then the preliminary assessment, and then I'll do walkthroughs of the controls. You were talking about doing that. We're doing walkthroughs of the controls to obtain the understanding and also to get that preliminary evaluation of control risk. Okay. Then later, based on that, we think the controls are strong. We'll do a lot of testing of the controls. Make sense? Okay, that's the deal. All right. And so we'll obtain an understanding, assess control risk, and later we'll test it. That's off of a future chapter. Okay. Then we're going to gather information to assess fraud risk. Are we doing a fraud audit? No. But if fraud comes to our attention, are we responsible for letting management know about it, of course, right? You go to the next level of management or the one above them, or if it's upper level management, you go to the audit committee of the board, right? With the information, okay? All right, anyway. And develop an overall audit strategy and audit program. The program is step by step what we're going to do. We talked about that a little bit last time. Okay, so you got the idea? So here's what audit risk is composed of, okay? And we'll have this to go along. See if I can actually write on this thing. I don't know. Let's try. Now it's trying. So much junk. more inherent risk there is, what do we mean by inherent risk? The risk there could be a material misstatement in the financial statements. That's it. Okay? The more risky the business is. By the way, the closer they are to bankruptcy, more inherent risk. The closer they are to break even, being in a loss position, more risk. Right? Make sense? Okay, so the worse things are going. Okay? So the closer they are on their debt coverage, more risk. Got the idea? Okay. So inherent risk times what? We mitigate the inherent risk with internal controls, right? Control risk. The better the internal controls, the lower the control risk. The worse the internal controls, the higher the control risk. Make sense? So we do this outside independent estimate. There's nothing we can do about inherent risk, it's what it is, but we estimate what we think it is. Okay, and mostly this is subjective, not numerical. Okay, but you can catch numbers. Okay, then we look at the control risk. How good are the controls, right? Okay. Control risk is the risk that an internal control will not prevent an inherent risk from giving you a misstatement in the financial statements. There's a certain amount of inherent risk that you'd have misstatements in the financial statements, right, guys? Therefore, risk of audit failure, right? Audit risk. Okay. Higher the inherent risk, the more audit risk. Lower the inherent risk, lower. It's obvious. Okay. Control risk, what does that do? The lower the control risk, what's going to happen? It's going to lower your audit risk, right? Because the internal controls are better. Inverse relationship there. Okay. All right. The higher the control risk, obviously, you're not going to prevent the inherent risk from causing an error. Okay. A misstatement. All right. And then what else do we have? There's going to be one more piece. We collect substantive evidence. What's that? Detection risk. Okay? My detection risk is the risk that my audit procedures will not find whatever got through inherent risk times control risk. Does that make sense? The control doesn't find it, so I'll use detection procedures, right? Collect evidence supporting the ending balances. Okay, so let's say you want to have a particular number over here, 5%. And let's say we've got 100%. We think it's a disaster. Right? 1 second. We think it's a disaster. What if they have horrible controls? I don't know about you. I want there to only be a 5% chance that all of the substantive procedures I did, tests of details, right, tests of transactions, and tests of balances. I want this to only be 5, I guess, huh? You can't do that audit. It's way too expensive. They can't get it out. Okay, got the idea? But what if this is 100%? So it's still a risky environment, but they have really strong controls. Now what are we down to? 20. And this is, you just think about it, right? I mean, you don't really know the numbers. There's no way to measure them. If I want 5% over here, what do I need, guys? 25. Just like that. But let's say we've got this kind of environment, right? It's still a real risky. By the way, if this is less risk than inherent risk, it makes your audit easier, of course, right? Okay, so let's say that's 100%, but this is only 10. Now what do we got? It's a nice rope we're living in now. This is a relatively inexpensive audit, okay? And you can just keep going. If it's only 50% inherent risk and it's 10% control risk, you're already at 5. You would never do no substantive work. You'd still do substantive work. It's a very easy audit, very inexpensive audit. Got it? Remember, though, our tests of controls, we cannot test this. How can you test the inherent risk out there, right? So you just estimate it. We do tests of controls to determine what this is. Okay? Our tests of controls will give us the control risk. The better the controls, good by design, and they use them. You know, they have really great design and nobody follows them. That's what your test is for. You know, you find, oh, they're really good design. This is a disaster. They have really good design on the controls, and you go out and you test them, and you find out nobody's following them. You just wasted a whole bunch of money, because what happens? You set your control risk high, and your detection risk has to be low, which means what? Low detection risk comes from what? Doing a whole bunch of substantive procedures. Expensive audit. Real expensive because you're testing the controls, wasting your time now. And now you have to do all the tests of transactions and tests of balances too. Getting the idea? It's substantive. important for your client to tell you the truth about their controls? Yes. In your preliminary assessment, it's important to talk to people and find out if they're really following controls or you just read their manuals. Reading their manuals is pretty much a waste of time. Right? You do it so you can find out what they're supposed to do, but then how do you really find out what they do? You talk to the people who are doing it, right? You get out there and you have chats with them, don't you? What do you really do? Have you ever seen this? I like that. Have you ever done that yet?
We've had an email before come, they forwarded it us, and the person flat out said, I've never heard of this control.
Yeah, I don't. Yeah, so probably it's not being followed very well. Oh, you know what's funny is I've seen situations where you have really experienced bookkeepers in the situation, and you look at their controls by design and they're non-existent, and then you go talk to the bookkeeper, and they really know what they're doing because they got trained, years and years ago maybe, and they just have everything totally under control. You're like, holy crap. So, do you have any, or you'll ask, do you have any controls over cash disbursements or cash receipts? And no, we don't, I don't think so. And then you ask what they do, and it's like, oh my gosh, all the duties are segregated properly, and everything's properly approved, and these people are just really, well, yeah, but you need to do that, or, somebody can steal all the money in the company. Well, yeah, that's what the controls are over cash disbursements, for instance, right? Cash receipts. So anyway, it's kind of fun to get out there, isn't it? Find out what's really happening. And people will tell you, gain their trust, right? You're nice to people. Did I tell you I worked with a guy who would bring flowers? When he first started engaging. Plus he was good looking and terrible. So he's a good looking guy, and he's single, and he's young. And he'd bring flowers to all the, now they call them administrative assistants, all the secretaries in those days. It would have been creepy if he hadn't been so good looking and sweet. But it wasn't creepy. Instead, they all loved him. And they'd tell him anything about anything. It was amazing. I had to use a different tactic because I was kind of an ass, crazy, and not very attractive like now. Yeah, so, see, you have to have different techniques. What I do is I make their life easy. I go in and I somehow make their life easier than it used to be. And then they like it really well. I was married in those days, so good flirt. I'm not suggesting flirting is an option. I'm suggesting being really nice to people. But his was bring them flowers. He'd show up with roses for everybody in the place. Yeah, gave everybody a rose. It's like that kid that gave everybody in his high school class, right? Not just his class, but maybe it's grade school, but it's everybody in the school. He gave all the girls. Sexist, because the guys were too. Now the guys think nobody loves them. Terrible. Anyway. All right. By the way, that is not illegal activity, giving somebody a flower. And it didn't compromise your independence either. All right, you got the idea how this thing would work, though? Yes, sir. Go ahead.
What's the detection risk?
Detection risk is the risk that the evidence you collect, substantiating ending balances and testing transactions, both. By the way, testing transactions is going towards substantiating the balance, right? Because the transactions are recorded, and when you add up all the transactions, you get the balance. Right, guys? Certainly true on revenue and expenses, but even on assets, liabilities, and equities, the change in the balance is due to transactions. So when you test the transactions, you're testing the activity that's getting recorded. And when you test the ending balance, you're testing directly what's on the financial statements. So you reduce detection risk by looking at more. If I look at every single transaction in the company, I don't have much detection risk left. If I look at every single balance and I really audit the hell out of it, right? I don't have much detection risk left. Of course, that audit is impossible because it's too expensive, right? So you're balancing cost and risk all the time. So did that do it? That's detection. Control is that the internal controls, their internal controls, will prevent or find and correct. Either way. You can have preventive controls, right? Or you could have detection controls, right? And the detection controls, their control would find an error and correct it, right? Also called correction. Okay? Got the idea? Or they can prevent it. I prefer preventing, of course, right? But either one works just fine. Okay, so different types of controls. But those are their controls, and what we would do is we would we'd obtain an understanding of those controls, evaluate those controls, get our preliminary assessment, and then we'll test those controls. First, the preliminary assessment is to decide whether or not we are even going to test them. Right? If they're good by design, we'll test them. If they're poor by design, don't bother. Got it? Is that getting there? Okay. Good. This is pretty good stuff. All right. So So terms, acceptable audit risk, inherent risk, that's death. Okay. Make client acceptance decisions. Okay? It is not automatic. By the way, there's acceptance and continuance. Guess what? Acceptance is the first time you have the client. Continuance is, do I still want the client? So every year you're accepted them different. What if situation changes with the client? Think about Enron. Think about WorldCom. They started out normal companies and turned into massive frauds. Did Arthur Anderson do a good job of deciding whether or not to continue? With hindsight, no. I would say with hindsight. At the time, do you think they thought they were doing a good job? Yeah. However, it was by far, Enron was by far the biggest client, both of which are some of the biggest companies in the world. Enron was by far the biggest client in the Houston office. Right? They had not done a real good job of deciding whether or not they wanted to continue. In fact, people did challenge partners. This is a high-risk client. They talked to people in Chicago, that's where I trained. They talked to people in Chicago, risk partners. And they evaluated the risk and decided, yeah, we should keep them. With hindsight, I bet there's not a single former Arthur Anderson partner who didn't wish they had just cut the cord on Enron or never heard of Enron. Same with WorldCom, right? A whole bunch of different. But that's true of every firm, right? True of the firms that survive, too. When you have an audit fail, don't you wish you never had that client, ever? So this is how you avoid doing business with thieves. You keep, what's the term? I trust my clients. I trust all of them, and they would not be my client. What am I maintaining here, you guys? Professional skepticism. I trust all of you guys, but I still have professional skepticism. By the way, do I have students cheat in my intermediate accounting class when I give them take one test? Is there anybody who takes more than 3 hours ever? Is there anybody who looks up an answer ever? Are there ever, I hope this doesn't happen, but do you suppose there might even be situations where students work together? Hopefully the really big ones.
Aren't accounting majors and just are trying to not fail your class.
Yeah, you get some of that. Do I have principal students copy each other's papers? I know they do because they'll have the same wrong answers, 3 of them sitting in a row. It's all right. What the hell, who cares, right? Really? You know, copy somebody who's wrong, that's all right. Okay, I'd be kind of angry if it was one of you guys sitting there and they're copying you. I told you I had people in audit who were cheating, right? Before. So you got when you're in intermediate. You got that. In auditing, I had an auditing class. They were sitting in the MBA.
Oh, yeah, you talked
So
about this, like,
yeah, they're sitting in the MBA. You guys, some of you guys are in the MBA. Can you imagine sitting in there in the top row while somebody's supposed to be covering material and you're working on your auditing exam together and passing answers back and forth? Did that ever happen? Yeah, it did. I maintain my professional skepticism, right? I know people have foibles, you know, whatever you want to call it, right? There are unethical people on earth. I just don't want anything to do with any of them, right? I've never had anything to do with those people that I thought cheated. I told you guys that a couple of them, I had big four firms, several big four firms call me and ask me about it. I didn't blackball. It's just unethical. It's illegally. I just said I cannot make a comment about that person. What do I say when somebody calls me about it? The truth. I think you're wonderful. Right? Why would they hire somebody from some other school but they hire you guys? Stupid. Why should you do that? We have really good placement of students, don't we? Why? Because you guys are really well prepared. Right? Academically, professionally, you've been working out there. You guys talk about did you have to go to work today? You think everybody does that every other school? No, and the firms know that, right? You guys are out there working, and then you do full-time internships. You're crazy people, right? That's what they want to hire is crazy people that'll work that hard. And then what else? I think you have a really high level of integrity or you wouldn't have stuck this long. It's a horrible environment to be in. Can you imagine being in auditing cheating? Oh, I had them. Class of about 20, I don't know. I got about 5 that cheated. You know what we did, right? We took a vote. No, maybe it was 10 or 5 cheated. Not even like that. It was awful. It was awful. We took a vote on whether or not we were going to let them keep their scores. Because we can tell them cheated, we did, and then get them confused, and then make them do it over. That'd be unfair, right? No proof, really. Sort of, but not really. And we had to go to court, you know, or literally, right? So what I did was I gave the class the option. Redoing every single quiz, test, for about halfway probably was leading it because he is by far the most challenged of the group. Got a job with the big force. No, saving lives. Stuff is really critical. That's really important. Think of the world we're living in. I don't want to do business with crooks, right? By the way, I still know who he is. I'll never forget. If anybody ever asked me about him, what would I say? No comment. No comment. One of my former students now, years ago. No comment. Don't ever ask me. Don't ever ask me. We've had people go out and do really stupid things. I told you guys about, you write down every single minute you work and let the senior worry about writing it off. It's their job, and the manager and the partner write down every minute you worked on something, every single thing you did. We've had people go out and not do that and not get hired at the end of their internship because of it, because they lack integrity. In one situation where a guy though went out on a, I tell you about this thing, went out on a inventory observation and refused to count to the client. The client wanted him to count the inventory instead of doing testing. He's supposed to be observing and doing testing, so he refused. And the senior got mad at him about it because apparently the senior was having everybody on the crew do that for the client. What do you think of that? Senior should be fired, huh? You observe the inventory, you don't count. If you count and you record it and they use that value, now can you audit it? Of course not, you're auditing your own work, right? You wouldn't do that. No way in the world would you do that. And so this kid gets in trouble with his senior about it. And he refused to do it. And he was the only one. He stuck to his guns. And then when it came time to get the offers, they didn't even know. And he was just a star. I called up the managing partner and said, what the hell? What are you doing? Did you really? What happened? And he says, well, Keith, he did a great job. He's a great guy. He has a high level of integrity, but he pissed off the senior, and we just can't, we can't have that. Him starting his career here with that ill will. What? Are you finished before? What? Really? So I called up the other three, and he got 3 job offers. I'm not kidding.
Could they not have just made sure that he was never with that senior again?
The senior talked to the other senior. She was difficult. So don't be difficult. But maintain your integrity. I've been fired a few times in my career. I was working with a guy that he was a tax practitioner. 2 tax practitioners. And the guy that their other partner didn't know much or anything. That was my take on it. But anyway, I was their outside independent reviewer. They had an audit for us. So I was doing those, and I was doing their reviews. Outside independent reviewer while I was teaching at Central Western University. They were in Yakima, Washington. I was making almost as much working for them as I was making teaching college. Only it was in my spare time. Right? And public accounting pays. He doesn't. I didn't have a PhD yet at that time. And so it was really bad. But anyway, so we're working on this thing, and I had a student, former student, that was doing the audit worksheet at the senior level or something. They had a staff level at the senior level. And she says, well, Keith, I'm really uncomfortable about their inventory. What do you mean you're uncomfortable about their inventory? She says, well, I don't think we really audited it. I don't think we did what we documented. Really? So then I started really getting real critical about it. It wasn't even well documented. And she had objected to what they were doing, and they wouldn't let her document in the work papers, and she objected. Those were told. Remove those that she put in, things like that. And so I went into got a couple of partners together and said, hey, this is not going to fly. You can't do this. I'm not going to sign off on this. And so we fought over it a little bit, dealt with straight from that. And the managing partner said, Keith, we were going to offer you a partnership. Now we can't do that. My response to that was, I don't want to be your partner. I would not accept a partnership. I don't ever want to work on anything with you ever again. And I hope none of my students ever go to work for you again. And I left. I was making about $20,000 from them. I was getting about 18. And I walked away. stolen, I'd say, wouldn't you? So they're out there. So, and they're in this town too. They're everywhere, right? So what are you gonna do? What are you gonna do? Okay, where are you at on this? So you have to be willing to walk. You have to be willing to fire a client. Should Arthur Anderson have fired him? Yeah. Would it have made their Houston office about 1/4 the size that it was? Yes. They had to fire a whole bunch of auditors if they lost that client. You know what? They all lost their jobs anyway. When it folded. Yeah. So did a whole bunch of partners lost their investment all across the country. So anyway, client acceptance and continuance, big deal. Identify client's reason for the audit. Why do you have an audit? Right? And is it legitimate? Are you spending money for the hell of it? Or you really need an audit? Yeah. You know, you don't give anybody any services they don't need. I've had a lot of clients where they come in and they say, we need an audit. You know, our bank says we need an audit. I say, really? You're a tiny company. Say it that way, but you know, are you sure you're big enough that you need an audit? Are you sure the bankers said an audit? Well, we think so. You know, you call up the bank and they say, do they really need an audit? No, review's fine. Sometimes even, no, do a compilation. I know they don't know how to do financial statements, I want you to get involved so they have a good financial statement. What does a compilation cost compared to an auditor's cost? Maybe 1/100th. A review compared to an audit. 1/10. Depends on the engagement situation. Audits are really expensive. Who should have audits? People who need them. Don't ever do anything for a client that they do not need to have done. If they are not going to make more money as a result of what they paid you than they paid you, something's wrong, right? Just
How would they want to do that? Like, what would be the point?
why would they want an audit?
Yeah, why would they come?
Because they thought the bank insisted on money, they wouldn't let them renew their line of credit, or wouldn't loan them money in the first place.
Oh, so like they
Yeah,
thought
they thought they had to have an audit. Most people don't know a review or compilation exists. Oh, I need audited financial statements to sell my stock or something. By the way, if you want to sell across state lines, do you need an audit? Yes. Yeah. But if you want to just attract a few investors and they're knowledgeable people, do they have to have an audit? No. Does a bank have to have an audit? Of course not. Banks loan all the time. Just real small businesses, they don't even have a compilation. They just loan to them, right? Usually their house is collateral or something, whatever assets they have to provide security for the loan. As the business grows, then now I want a compilation, and then, as it gets even bigger, now I want a review, limited assurance, and if it gets real big, and I got a lot of money on the line, and a complex transaction, I'm really worried about the situation, not real worried, but getting to be, this is serious, I want an audit. Right? This is awful. This Casey, I'm involved in Education Council, Economic Education. I found some old statements for them. I found their articles of incorporation from 1974. Now, it would be quite a while ago, huh? It's a black binder book, no kidding. Got their articles of incorporation, their bylaws, and there's also their original budget in there. It was $30,000 the first year. People were donating $30,000 in their operating budget and fundraising budget to everything. Everything they were going to, all the services they were going to provide were program budget was about 30 grand, real close to 30. And then I found one from 1998. How many years is that? 74 to 98. 24 years? Yeah, 24 years. Their revenues were $1,000,001, and their expenditures were close to $1 million. Because it's a nonprofit, they're supposed to spend everything. Well, actually, it's probably over, maybe $1,050,000. Right? So they built their endowment a little bit more. Right? But you know what their fund balance was? $950,000. They weren't trying to build a fund balance. They just were really good at getting contributions in. They kept the costs really low, right? And they were providing all kinds of services. What they did was, then and what we still do, is educate teachers about economics when they're supposed to go out to schools and teach kids about economics, right? The fellow that had started this thing, I don't know what year he retired. He was a U of L that started it. He was working for free. He's a faculty member, right? So his outside service was to run this thing. So he probably got more students or something, taught one less class or something to do it, right? Which is what I'm supposed to do. So people learn this. Anyway, so now I'm teaching more. But anyway, that's all. Anyway, so Richard's fault. Anyway, so he retired, and by 2006, they had $34,000 left in the fund. And president now, no longer executive director, their president, was making $83,000. Right? Had gone from 40 to 83 in just a few years. Right? Like two. And her assistants, these were women this time. Terrible. Women did this. Yeah, anyway. It's a nonprofit. So, there are women who are thieves too. Her assistant was making 53 or something thousand. They were $135,000 paid for this little thing. You wonder why they went from 950 down to 34? Now we're back up to 120, you guys. We're doing pretty good, huh? As a fund balance. Quite a mess, huh? Wow. And they were pulling in $1 million a year and spending $1 million a year, and now we're pulling in a couple $100,000 a year and spending, which is a big improvement over where they had been. Wow. Finally got rid of those people 3 years ago when Belgium took over, right? So you can feel good about Belgium on this one. And happy to the education system. Undid it. Got rid of it. Are we ever getting the money back? Oh, what did I tell you? In 1998, that was their last audit. Approaches exhibit. Every time after that, they had a compilation from some little CD from I'd never heard of. Very little. What's my impression of that CPA group? Even with the compilation. What's my impression of the board members? What do you bet the board voted to approve those salaries? If they didn't, we might have a case. Maybe. Right? Not much. Salary. Not stealing it, you got you negotiated it, right? So anyway, yes, this stuff's real. You're gonna be out in this world, huh? By the way, is there anything wrong with somebody making $200,000 a year? No. $1 million a year? No. It's okay. As long as you earn it, right? Whatever that means. Not politics you're way into. Okay, anyway. So what's the client's reasons for an audit? Obtain an understanding with the client. That's right, that engagement letter. Develop an overall audit strategy. Huh? What we're going to do. So obviously. Obviously. Okay. So, new client investigations. If previously audited, new auditor is required to communicate with the predecessor. Everybody got that one? Required to communicate. Is the predecessor required to communicate with you? The answer is no. What if they have not been paid their fee? They'll probably say, I have not been paid my fee. I am not going to talk to you. And what do you do now? You want a client that doesn't pay their fees? Probably not. You'll refuse to client. Okay? Client permission is required because it's confidential information. You cannot talk to the predecessor without the client's permission. What if they say no? Personally, I don't want the client. Now, by the way, might there be fights between a former auditor and the client? Especially if it's a real small firm and they're losing their biggest client. That's how they were making their living. It was terrible, right? And now the client got big. They didn't grow. And now they're losing the client to you. Would there be animosity? Yes. So you have to deal with that. You explain to the client that you're just going to find out what's going on and where there are issues relating to accounting and all of that. Okay? You can find out whether they pay the fee and all that stuff, right? But they probably have if they were growing and they just outgrown their old auditor. If you're the old auditor, what should you do? Of course. Communicate with the new auditor and help them every way you can. Suck it up. Do business, right? Grow your business, right? So, sure, you can use those lines. It's no big deal. Well, painful when you lose. Continuing annual evaluation of whether to continue based on issues of fees, client integrity. If they haven't paid my fee, am I independent? You guys already know this one, right? No. So I can't do the next year's audit until they pay the fee for the prior year. That's true. Okay, or if I'm going to court against them, they're suing me or something. Okay. Two major factors affecting acceptable risk: likely financial statement users, who's going to use them, intended use of the statements, what they're going to use them for, borrow money or issue stock or whatever. Likely to accumulate more evidence for companies that are publicly held, no kidding, have extreme indebtedness, they're in trouble relative to their assets, of course. Likely to be sold, okay, divorce proceedings and small clients. Okay, obtaining an understanding, engagement terms should be understood between the CPA and client. Standards required require an engagement letter describing the objectives, what you're going to do when doing an audit, responsibilities of the auditor and the management, schedule and fees. And usually what we'll do is we will tell them basically what's going to be in the audit opinion. Right? You just lay it right out in the engagement letter. And the example they showed you in the book is just like that. It just says basically what we are going to attest to, like what our opinion is going to be. It informs client that auditor cannot guarantee all acts of fraud will be discovered. Okay? So see figure 8.2, which is the engagement letter, I bet.
C12.
There it is. Don't memorize this, but read it, you guys. Read it seriously. You know, I like to have a time schedule in there. I like to tell people when they're doing what they're doing, when I'm doing things, what I'm doing, basically. Now, you can't tell them what your audit procedures are, but I like the list of PBCs to be attached, prepared by client with due dates. If you don't have the due dates, if you want them to give the PBC, they'll give them to you really late, and then you'll be beyond the date when their financial statements were supposed to be done, and then they're missed, right? But if you give them, you guys do this, your engagements, see this? You give them a list of when they are going to deliver to you, and when you will be done, right? Handling it, and how this whole thing's going to work. If they don't meet their dates, you give me the inventory, right? The inventory listing, and where it's all costed out and everything. You give me the inventory by a certain date. And if they don't, that number of days is added to when the audit's done. And it'll keep things going. If you don't do that, then things fall apart. They'll do other things that are important. Okay, so you make yourself important. And you tell them exactly what schedules they're preparing. Okay, so you can get some staff assigned to it, find out who's going to do that, the PBCs, prepared by clients. Okay, so we're going to consider client's business and industry, material misstatement risk areas, number of client locations, past effectiveness of controls. If they had good controls before, it might be an indicator they're going to be good now. It's not always, but you know, that helps. If it's the first time through, that's tougher, huh? Anything, by the way, a first time through audit, the first time you do an audit is far more expensive than repeat audits. It just is. So that's one of the arguments about this rolling auditors every 5 years. What's going to happen? Costs a lot of money, right? Can we get better audits? I'm not sure, right? Maybe more independence, maybe, right? But more expensive, absolutely. Okay, possible. Switching auditors is expensive because they're not familiar with you. Okay, so anyway, staff continuity, need for specialists, sure. So resource requirements. Okay, gaining an understanding. How would you gain an understanding of the client? Read about the industry. Read about the client. Okay, talk with them. Okay, so what types of things might be risky for us? Declines in economic conditions, out the economy as a whole, information technology changes. There is, you know, one thing that can make a client really risky is they have installed a new computer system. The old one's going out and the new one's coming in, and they're running both of them at the same time, right? Hopefully they're running both of them at the same time. It's worse if they just shut one down one day and they're going to use the other one the same day. That's a disaster because it doesn't work. Now you have no system. So you really what you try to do is do both of them at the same time, which is extremely expensive and really annoying. It drives everybody crazy, right? It's very redundant, but that's what you do. And you phase into the new one and out of the old one, right? Okay, so you do it dual. So anyway, so information technology, global operations, where they're at, what they're doing, human capital, who their employees are, if you have a union or not, right? Might make you have better control or worse control, depending on what your relationships are like with the union and what the skill level is. Okay, so anyway, all the things, we talked about all these things pretty much. Oh, tone from the top, though, we should mention, really critically important. If you get a feeling that the management of the company doesn't take the audit seriously, you're probably in trouble. Or they're hostile towards it, or they're real secretive. Well, you know, if I tell you this, I'm going to have to tell you, you know, not quite in those terms, but close. Yeah, we're in trouble. I told you about the client I had that didn't want to tell us about his commodities trading. And the reason was he's lost more than the profit for the year from everything else. Trading, hog belly, futures, stuff. I'm not kidding. Things that have absolutely nothing to do with the business. In gold and silver and platinum, you name it, corn futures, literally hog bellies. You know, so his mom was on for some shareholders to review it with engagement. And I insisted until he finally gave it to me and he recorded none of the losses. And it wiped out, almost bankrupted out in 1 year because he was gambling. And she did not fire him. He was her son. He was her only son, and he was going to be taking over the company. She just wouldn't let him have a trading account. And he just ran the business, and it made money. It didn't go bankrupt. But if we hadn't found out about the commodities trading, what would have happened? We would have issued a review report saying everything looks okay. That's what you say, basically. I think when they were on the ropes, they're in trouble. Huh? killing chickens in her garage. Not the case. And it grew into the biggest poultry outfit in the state of Washington. Pretty cool. Yeah. Probably the biggest one in the Northwest. They're nothing like Tyson or something like that. Oh, they still exist. I bet you go into the ground and they got bought out by Tyson or something. For nothing. Yeah. Because grandma's long, long gone. She was old when I was a young guy. So, yeah. So anyway. All right. So management and governance is really important. And does the audit committee take it seriously, right? Okay. So what are their objectives? By the way, what if everybody in the management team, all they can think about is generating more wealth? It's just all we do. We've got to beat last year. We've got to beat last year. We have to have better earnings per share. Is that a risk factor? Oh, yeah. Because they want to look so good. What's driving them? You know, is it immense wealth? Is it prestige? You know, or is it running a business and doing a really good job and, you know, taking care of all our stakeholders? Our employees, our vendors, our customers, you know, our shareholders, our creditors. You know, are we going to just take care of everybody, right? Which is, by the way, not all that noble. It's a long-term profitability plan, right? You treat everybody really good. You take care of everybody. Don't rip anybody off, right? Okay, so it's not about eking out as much profit as you possibly can in every single transaction. If it is, people catch on to that. I mean, profit for yourself, personally. Right? Shareholders don't like it very well either. If all you're about is getting your compensation level up, right? Making your bonuses or whatever. Okay? So don't go there. And you can get a feeling for this, you guys. You can find out really, really fast. What's their lifestyle? What's their attitudes? What do they talk about? Okay? And you'll get an awful lot of feedback about those things. So anyway, yeah. So industry and external environment, right? Why would we want to do that? Well, they're more risky in some industries than others. We talked about that. Inherent risk common to all clients in certain industries. Unique accounting requirements. We need to make sure we have the expertise. Okay, operations and processes. What are their major sources of revenue? What's their revenue model? How do they make profit? Who are their key customers and suppliers? What if they only have one customer? What if they only have one supplier? Scary, right? They might, although, you know, it just depends on the situation, okay? Sources of financing, who put up the money, right? Stock and bonds or debt in general. Information about related parties, you need to understand that, of course, okay? So you're going to tour the plant and offices, tour the physical facilities, enable the auditor to assess the asset safeguards, interpret accounting data related to assets. By the way, internal controls are not just to safeguard your assets, right? They're to run your business, okay? Be as profitable as you possibly can, okay? And do a really good job for everybody. Okay, so anyway. Identifying related parties, affiliates, right? Subsidiaries, affiliates, okay? Principal owners of the client, so major shareholders, any other party with which the client deals. So, by the way, if you only have one customer, are they a related party? I guess so. Only one vendor, are they a related party? I guess so. Right? So, you know, people who can exercise undue influence, right? Okay, or vice versa. Party who can influence management or client policies. Okay, so you watch for all those things. Right? Is it okay, by the way, to do business with related parties? Can you do business with your subsidiaries and your affiliate companies? Of course. You just want them to be at arm's length, right? You want the transaction to be reported as though it were arm's length. That's the best idea. Is it arm's length? No. So what do? You disclose, right, in the notes of the financial statements, all the related parties, all the material transactions. And then a financial statement user can draw their own conclusion, right? You learned this in intermediate, right? They can draw their own conclusions about whether or not they were related, whether the related parties were really arm's length transactions. That's all. Okay? Management governance, the organizational structure board, the audit committee, talked about that a bit. Okay, your corporate charter and bylaws, we read these things, keep them. Which file are you supposed to keep that kind of stuff? Permanent file? Yeah, permanent. Code of ethics, if they have one. Is it a bad sign if they don't? Yes. Does it mean they're ethical if they do? No. But if they don't, it's kind of, what? You guys don't even talk about this? Meeting minutes. Have you guys been on a minute review yet? Anybody get to, that's boring. You get to read minute after minute after minute, and what are you looking for? A dollar amount? New people, right? But you're looking for any transactions that might be material and making sure they're disclosed, right? Any information that might be necessary for financial statements. Or any lawsuits, all sorts of things. Okay? So it's called a minute review. Management establishes the strategies and processes followed by the client business. Of course, it's how